right, good morning, and thank you for joining the call today. We did a little, or at least tried to be a little bit like HBO, and gave you an all-access pass. So today, like I was as a boy in Thunder Bay, Ontario, because we could never really afford HBO. I love getting it for free when I could get it. So you're going to see the whole process today. Already received the data, the risk range product, for example, the early look. Now you hear the call. This is the research meeting. Then we roll into the macro show. And then throughout the day, we'll have real-time alerts. I'll also do a real-time alerts live session where I'll just rapid fire on tickers, giving you setups on the trade trend tail model. Again, our process is rules-based and mathematically driven. If you can stand my style, you'll get that it's all about the math. All right. One of the guys who always says, function, what is it, Howard? Function in disaster and what?
God, I even forgot.
Finish in
Emily,
style.
Finish in style. Yes, Emily, thank you. Because Emily went to the school that, what was her name, Emily? The woman, the headmistress?
Lucy Madeira Wig.
Right.
You're talking about the one that... Are you talking about the one that coined the phrase "function in disaster"?
Yeah.
Finish style. Yeah, that was Lucy Madeira Wig.
Yeah. So yes, thank you, Emily. Keith, so I'm doing my best impression of you this morning, doing the call from a car. So the McDonald's reported numbers, a miss on the bottom line, 223 versus 234, but not expected given inflation. But importantly, the top line was much better than expected. Comps up 12.3 globally versus 10.5. US up 7.5 versus 6.9. And just to put this in perspective, if McDonald's does a 5% comp annually, it's like a incremental $1.5 billion in sales coming out of the rest of the industry into McDonald's. So part of the reason why we're short QSR, restaurant brands, QSR is a symbol, is because of the strength of McDonald's, especially in the US. So that 7.5 comp is going to hurt a lot of different players, especially the smaller players, and in particular Burger King. So feel good about the short on QSR for that. And then internationally up 16.8 versus 16.5 in the operated market, and then developed licensed markets up 14.2 versus 9. So pretty strong across the board top line, and the operating margin actually beat 43.4 versus 42 consensus and 36.7 a year ago. So we put McDonald's on the long list here in preparation for a quad 4 in 2Q at the beginning of the year. So feel really comfortable about where we are with McDonald's, and I think the stock may be down slightly today because of the EPS miss. But that's not concerning to me. The strength of the top line is really what we're focused on for McDonald's, and frankly, the flight to safety, as we put in our Teams deck a couple of weeks ago. So that's it for me this morning.
Yeah, it's an interesting one. I always take what tickers do on the news. Clearly, the most bullish same-store sales news that McDonald's has maybe ever had, and even that stock can't go up on the news. That's so bearish from a market perspective. McDonald's would certainly fit the profile of things that you could be long against your super duper stock picks on the high growth side that are going to continue to crash, because it will just not crash or go down less. But really important to watch how stocks do on the news, in particular, since we're coming out of peak cycle earnings. So it's not just peak cycle Fed hawkishness, peak cycle interest rates, peak cycle inflation, but peak earnings. And that's the easiest call to make. We're going to have a massive earnings slowdown in the aggregate for the S&P 500 in Q2. So I think a lot of stocks are discounting the future as they normally would, and maybe that's part of it too. So Howard will have to see about that. All right, thank you. Drive safely. I'm not sure if everybody knows, but I do have an autonomous button on my car, so I'm not actually driving it outright all the time. Not that anybody cares.
I'm technically not driving right now. I pulled over to read the McDonald's press release, and I'll be on the call later, but just in transition right now. So,
well, imagine the alternative. You're like drawdown Josh Brown, just commenting on any stock, never having opened a spreadsheet or built a company model in your life. It's just just a different way to do it, I guess. All right, thank you for doing real work. Appreciate it, Biolsi.
Good morning, Keith. So you spoke about rising prices yesterday when we spoke, so I wanted to hit on that in staples. We haven't seen much of that substitution yet, and in my note today, I had some surveys about consumers, and they're voting about what product categories they will substitute or have substituted. What we've seen is it's highest in meat, which makes sense. There's not a lot of brand equity in meat, but lowest in beverages. And I think I reflected that in some of my picks last week. So shortages play a big role in that. There's the out of stock level is higher than it normally is or almost ever is. So, consumers continue to grab their brands and the products when they can. So that's part of why they're just buying it even when there's high prices, because they're worried about not having it there the next week. So I think when that changes, we're going to see more substitution. But, since you just brought it up, Keith, talking about stock reactions, Kimberly-Clark, ticker KMB, reported yesterday. So that's a very strong quad 4 stock, but I didn't add it to my long list when I added a bunch of names to the long list. It's implying a 5% price increase with only like a 1% loss in volume. So not a lot of, substitution there, but their pricing and the pace of that pricing is well behind the cost pressures they're experiencing. And that's really polymers like for the diapers and pulp inside the diapers, which also for toilet paper, right? But that's just oil and wood. So those costs aren't like the other costs increase. They're sort of unique, compared to the rest of the industry, and they're not, particularly behaving like some of the other ones that aren't seeing that, like corn, for example. So with all of that, they slashed guidance, and the gross margins just don't look good. This next quarter is going to be worse than this last quarter. So they're going to be well behind the names that I added to the long list in terms of the recovery and margins, but their stock was only down 3.5% yesterday. And I think that signal says, even as bad of a quarter, and that's they've lowered 3 times in a row and then just lowered the year again, the new year, and it was only down 3.5%. So it's pretty tough to beat up some of these staples names when they're doing this poorly. And, I have a lot of names that are going to do well pretty soon. So just wanted to flag that there.
Yeah, it's the opposite of the inflation curve. So you just take every, Tom, Dick, and Harry macro tourist out there who's now concerned about inflation after Hedgeye made that call for 18 months prior to that. And you take, all their brothers and sisters who are short consumer staples on rising input costs, and it's all the same thing. I mean, you should be reporting the worst of times as inflation hits the peak cycle of times. I mean, that's why these stocks go down less and less on bad news. And that's why you buy them for the future, because as inflation comes off its cycle peak, back half of 2022. And again, we're talking about real investors looking for actual stocks that they could buy here, where you can see a rate of change acceleration in margins or margin expansion and earnings embedded therein. So that's how to think about it. Instead of the quads, it's called the pods. The quads were born out of the pods. For those of you that are new to this, that's how we roll. I used to be like Daniel Biolsi, a hedge fund analyst, and then we grew up and we went to Hedgeye, and now we took the pods, so the rate of change of revenue growth and pod 1 and pod 2 cash flow growth. If you get the rates of change of those things right, you typically get stocks right. In particular, if you get the quads. So the quads, of course, you substitute revenues with real GDP, and pod 2 instead of that, you substitute the rate of change of inflation. All right, all good, Biolsi. Thank you for the quick and succinct recap. TJ, huh?
Yeah, quads and pods all over it, man. We've got our cruise deep dive today at 2:00, and ahead of that, we put on NCLH as a best idea long for a trade, and there's a number of catalysts, a lot of catalysts, and they're pretty near term, and we'll discuss all of them later today. But there's one I want to highlight, and that's pricing. We do, I think, the most exhaustive pricing survey on the street, and we also do it weekly instead of monthly. So the street does it monthly, and they get one point in time where we can aggregate and make sure that there's not anything flukish going on, and look at moving averages. And so it's been pretty consistent. The industry's been really strong in terms of pricing. Midway through wave, we're halfway through wave season. Wave seasons generally beginning in December to maybe mid-March, and that's the period where most of the cruises get booked for the following year. But NCLH, not only is pricing strong, but NCLH is the strongest on a year-over-year basis, and also for most periods, and also like momentum through wave. So they're actually gaining steam relative to the competition. And that's a pretty good catalyst, because they'll report earnings very soon, and they'll there's no real earnings yet for the cruise industry because they're coming from basically zero. So the forward commentary means quite a bit. Now, objectively, we have issues, as you know, Keith, I talked about in the past, long-term issues with the industry. It's not the greatest business, and we'll go into those in depth in the deck, because we want to like lay out the case across durations. But just real quick on quad 4, I'd just say a couple things. Cruise lines have actually done okay in quad 4. But more importantly, if you look at leisure travel, we made this case in our deck a couple weeks ago. Growth is actually, accelerating, because people spent really underspent by a large amount in terms of leisure versus, more durable or, hard goods. So basically things versus experiences, and experiences they've way underspent, and I think that's going to catch up pretty quickly. So we see a leisure powder keg there and accelerating growth, and that should move over to the cruise lines. So we're right on the near-term catalysts, which again, it's not just pricing. There's other things we're going to talk about on the call. This stock could really work, despite quad 4 over the near term. But again, it's a trade. I think a lot of the stuff that we're looking at on the positive side is going to come about pretty quickly, and then we'll reevaluate. And some of the long-term factors have to come into play at some point, like low return on invested capital. Which is, somewhat reflected in the stocks. These do trade at pretty low valuations, as they should. But Norwegian is the cheapest with the most catalysts, and that's of interest to us. That's it for me.
Ticker on that is NCLH. RCL, we've been getting asked questions on that because it's in my top 20 in signal strength. It's not signaling buy yet, but it's getting ready for that. It's always a process, a bottoming process, that is, for stocks and as much as markets that have gone down for a while. But if RCL can get above 82, TJ, that's trend. And then the other thing I'd say, we get a lot of questions on this. Oh, quad 4, why the travel, like Booking, Expedia, why are they outperforming? They should go down. It's like, well, you can't just look at a static quad table. I mean, that's for rookies, right? That's for somebody who is like, whatever, they've never played the game. They don't have a signal. It's a starting point. It's a reference point. Being macro aware of where the quad is just the beginning. I mean, there's a unique set of, easing base effects for travel and leisure stocks. So that's why, so if you look at the pods of the companies, they're some of the last places where you haven't seen the real acceleration yet. And that's why they outperform. The ones that have the toughest compares are going down, and they're slowing into the tough comps, and the ones that still have the easy comps are going up. And that's, you can see it from emerging markets to some of your stocks. And that's my answer on that.
Yeah, that's a terrific meld of, the secular and the cyclical pods and quads right there, Keith. Thanks.
Yeah, you're just being nice to me because there's a lot of people listening to that.
Well, I like what you had to say just then. So that's part of it too.
Yeah, we're nice to each other. We're not nice to people who are full of shit on Twitter. So that is what it is. Some people call it bullying. Where I grew up, it's just called calling people up because they're full of shit. I mean, okay. Thank you. McGough, you've never done such a thing, have you?
No, not me. So a couple of things this morning: Groupon, GRPN, and Playboy, PLBY. I'm going to hand it over to Jeremy on Groupon, but we had a nice win on this one yesterday with a lot more to come on the upside. I'll let him lay that one out, and then I got comments on the Playboy.
Thanks, Brian. So Groupon had a good day yesterday. We went long this a couple weeks back. Ticker for people is GRPN. Part of our bull thesis was around the company's stake in this European payments company, SumUp. Yesterday, it was reported by Bloomberg that SumUp was pursuing a 20 billion euro valuation in its latest private funding round. So that'd be 22.5 billion US dollars. We don't know Groupon's exact stake. It's likely in the 5% range. But that 22.5 billion value at the 5% stake would be, if we combine it with net cash at the end of the quarter, would be almost $42 per share versus the closing price yesterday of $26.68. So this is a targeted valuation funding round, right? So like a Groupon liquidity event might be lower, but we're even sort of discounting the valuation. You're looking at a valuation for Groupon that would imply its operations valued at 1 times EBITDA, 0 or even negative. So and we actually think there's a bull case, developing around the core operations as well. So on this news, we are buyers of Groupon. even with that 20% move yesterday, taking it up higher on our long bias list, on our long list. And yeah, we like Groupon here.
Yeah, for people that don't know what that long bias list is, each analyst or each sector pro product, which you can subscribe to, Brian and McLean will have on the board, best idea longs, best idea shorts, and then they'll have a bench of ideas that they're working on both the long and short side. So you can see the whole process there. McGough, what else you got?
Yeah, so I want to hit on Playboy for a minute. PLBY, this is a name,
nobody cares about that stock.
No one cares about it. We're going to ride it into the ground. So this is one where we originally made the call at $20, looked like heroes when the stock went to 60 over the course of, two months. And now, I got egg on my face that it's a $15 stock again. It fell victim to, quad 4 in a really big way. It has all the wrong style factors. We're going to do a black book on this one in about 2 weeks, and we're going to go really, really deep on all the growth initiatives here. The bottom line is I'm not going to say the pods are going to trump the quads because the quads are really damn strong. But I'm telling you, the pods look awesome. Revenue growth looks fantastic. Margins look really, really good. Capital intensity is coming off at a time when growth is accelerating. This company is doing all the right things. Problem is that this name has no institutional sponsorship. You can't I could take any name I cover and in 20 seconds or less, I can give you an elevator pitch as to why to buy it. You can't do that with Playboy. It's too complex. Is it an NFT company? Is it an old school kind of media brand? Is it a sexual wellness company? Is it a cosmetics brand? Is it an apparel company, a licensing company? We're going to basically boil it down into a very concise framework that, Joe Institution, who's going to move this stock, can actually get a sense as to what the value creation roadmap really looks like and how they get paid. So it's going to be a very good book. It's going to be open to Retail Pro subscribers. This is a name where I get a lot of interest from Retail Pro, and I want to feed the beast, and I want to give the people what they want. When the same way this name got cut in half and got cut in half again, once we're at a quad 4, and I know we got a long way to go, it's only January, but the pods are going to be absolutely humming at the same time. That day is going to come where the market starts to actually discount quad 1. And this thing is going to double, and then it's going to double again. I literally think by the end of this year, this thing will be at least a $45 stock. So if you got duration on your hands, you definitely want to be buying it here. Obviously, the signal matters and the quads matter. I'm not trying to make a case that they don't, but if you've got duration, this is one of the most mispriced assets out there. Centerfold right now, which is its OnlyFans competitor that just launched, is being valued at 0. Honey Birdette, great new company, the highest end lingerie brand in the world, which it owns, is being valued at 0. NFT is being valued at 0. So if you like doing the math on mismatches between what a company is valued at versus where it's trading, this thing is textbook. And again, the pods are accelerating, which I just love. Keith, I can't find a whole lot of companies in consumer discretionary where you got accelerating pods in 2022, particularly all of them going in the same way at the same time. So we like this a lot. We're going to boil it down in a black book, and we're going to go big or go home on Playboy.
Yeah, this is a great example of, you're going to always have a lot of interest. Because why? Because a lot of people, whether they understand the process yet or not, they're bag holders in this name. So they don't listen. They didn't listen when I said it to you, or they didn't listen when I said it again and again, that it was going to go down hard in quad 4. I even said that I'm going to keep it in real-time alerts just to use it as an example of a stock that I don't think will go to 0 in quad 4. But I'll hold it throughout the whole way, and I'm going to ride it if it goes to 0 with you. So I explained it, right? I mean, just to be clear, in quad, it's not like Playboy stops going down just when quad 4 ends and all of a sudden everybody's a winner again. It could easily go up from, literally the way to do this if you sold it like we did in with our asset management partner. But, again, it is what it is. What is your max position? If your max position is a 3% position in a stock, my minimum is 1. So if you didn't sell the whole thing, cut your losses and sell it to 1. So when right before the quarter, which is where you should probably buy it, and you buy 50 basis points or another percent of it. So you're at 2% that day. Like, that's how you do it. Okay. Not everybody does. In fact, nobody does it the way that we do it. So if you fucked it up, that's okay. I've fucked up way more times than you ever possibly can. And I've done it publicly, privately, and everything in between. So again, get better, accept it. You're not good at this. Neither am I. We always have to get better. And this is a shining example of that, where you can have a great stock idea, but the market and the machine in quad 4 is going to punish your stock picking ability. Okay. If you have it, like McGough does, obviously. Okay. Got to keep going here. Thank you.
Thank you.
And thanks for not hiding. Like so many creepy crawlers out there, they just run away when they're wrong. It is what it is. The process actually on risk managing this was dead right. Okay. Where are we at here? Dr. T on?
Yeah. Can you hear me okay?
Yeah.
Sorry to ask. My microphone was just misbehaving there for a second. I just wanted to, just on your last comment there around, super great stock idea, everything else, or, are you catching an inflection point, a falling knife, et cetera? The chart and table that we put together yesterday on Quest is interesting for that very reason. I think there's two things. One is how we've been looking at all these stocks relative to their own history, relative to the macro quads. That we have this wonderful tool that you punch in a ticker and you get the back test for average, median, and batting average in terms of performance. I think the additional piece, though, which we've hit on numerous times, but I think hopefully is clearer in that table, is that it's not just the macro quad. You also obviously will have the fundamental influence what that stock's going to do, and that all backs into whatever the estimates do. So these two pressure points, right? These two streams of influence. And if you get both of them working in concert, you get this a really directional result at a minimum, and maybe even an absolute result over some period of time. So Quest has what we call a micro quad 4 setup for their top line. That just relates to if you look at the NTM line of estimates, it means that it's sloping down to the right, and in relative to itself, it's it's sloping negative at an accelerating rate, which is what we call a micro quad 4. Historically speaking, across all macro factors that macro quad setups, that's a bad place to be for any of our companies. But as for Quest's performance in particular, that's true. And then if you layer on top of it, if you catch that micro quad 4 in a macro quad 4, those two things together, you get absolutely stretched on an absolute basis and on a relative basis in terms of performance. And so the grid that we put up was, okay, healthcare behaves really, really poorly in macro quad 3, less so in macro quad 4, but still pretty bad. But if you can focus on the names that are slowing, right? Like slowing because of either a COVID comp, or slowing because, and that's generally the theme here, or slowing because labor prices are going way up. So we're kind of negative on the XHS relative to XHE, but Quest sort of sits in that bin, where I think just because, right, the machine is recognizing both this macro factor and this fundamental factor in terms of where that estimate's trending, and it's a short, and it should continue to be a good short as long as we're in, both of those conditions are real. Even if the condition sets, right, like what if, I suppose if there's another series variant that could change things, but as long as COVID testing looks like it's rolling over, which it does, that's been a big boost for them fundamentally on the pricing and the volume. And then the base business can fill the hole, but it's going to fill the hole at a lower price point and a lower margin. You need a lot of base business acceleration to make that work. So hopefully that's becoming clear. We're trying to cycle through our names in a fast way like that. And there's a lot of big liquid, right factor exposure, healthcare names, particularly on the equipment side, that look good, right? Like that should perform well, backtest quad 4, but also have an upward sloping estimate trend. That's it.
Yeah, the odds of people who just joined the call for the first time and have never heard the Hedgeye process and watched something else, God forbid, understanding 1% of what you said is probably pretty low. But that doesn't matter. Everybody can get better. And you just did an excellent job, after 25 years of trying to get it right alongside me here. melding the quantamental together. You know, you got the quant factor exposures, you got everything fully loaded from macro quads to micro quads into fundamental analysis. And that's why quantamental is crushing Mr. Fundamental. And it will until it won't. And we're, you know, when it stops working, we're going to change and evolve alongside the game as we always do too. All right. Great job with that, Tom. Really good. Emily, you got on early. You wanted to get on early. You like it. You Nashville folk, you like an audience.
I'm here every day at the same time. I may not show my face until my tea is made, but it's my problem. First off, Anthem reported yesterday, and a couple of comments on their, on their commentary. Number one, like UNH, they're doing something very similar, which is running as fast and as hard away from being a health plan. And they say that, we're moving from being a health plan to being a whole person, whole care health services company, which is just code for just code for we're not going to take any risk on health anymore. We're pushing that risk into the providers, and it's going to be their problem. Then the other theme, and this came up in UNH, and this is going to come up with Teladoc and others, is when will the public health emergency end? And Tom is reminding me that the Teladoc is also in Quad 4. So the public health emergency, which I don't know if everybody's micro Quad 4, sorry. The public health emergency is becoming a theme too, which is, when does it end? The companies, UNH and Anthem, are banking on a termination of the public health emergency in April, which is the latest date to which it's been extended. That is very unlikely for a number of reasons. And the first of those is the states that are accepting enhanced payments from the federal government for their Medicaid programs really need to align the end of the public health emergency with some fiscal event, like the beginning or end of the fiscal year, which would be July or October, depending on what state you're talking about. And if they extend it beyond that, then it would then go and try and align with those dates in 2023. And this has implications all across healthcare, because what the public health emergency did is deregulate the system, and which is why you're seeing more procedures, more employment in the ambulatory space and outside of the typical the hospital space. And I think HCA made a comment about that, and J&J made a comment about that in their earnings as well. So I would expect the public health emergency to extend and help Medicaid enrollment at Anthem and UNH to extend into probably later in 2022 and then April. There just doesn't seem to be enough time to get ready for that. So although I have to say the healthcare policy management in the Biden administration is a little weird. So I could be wrong. I'm just going to caveat that. So that's it, Keith.
Politics would never be weird. All right. Thank you. Josh Steiner, aka the Stein Bomber.
Morning. So we're sort of in between earnings here. We're going to get, we've actually just gotten the headlines for MasterCard, beat on top line and bottom line, but the numbers literally just hit. So we'll go through those. We'll have more to say on that later on. We'll also get Visa tonight after the close, but I wanted to spend just sort of a minute kind of, contextualizing what we've seen so far. So if we're thinking about the financial sector overall, so Q4 results really have come in relatively strong, but these stocks just keep selling off on the outlook. So, expense guidance has caught people by surprise sort of consistently. Basically, every management team is obviously talking about expenses going up pretty significantly as they look ahead here to 2022. And then that's sort of been, offset to a degree with expectations from, offset from rising rates, and also from, ongoing benign credit. So if you sort of think about that and you look forward, both of those assumptions are, I would think lower probability. Initially, Fed tightening is going to trigger weakening credit quality. So we've already seen a little bit of that. We've obviously expired on the CTC December 31st. We rolled back the enhanced UI back in early September. So all of that is beginning to manifest. I talked about this a little bit yesterday with some of the specific numbers. And eventually what's going to happen is, both the market weakness and this sort of emergent credit weakness is going to trigger the Fed to pull back from its tightening cycle. So, the expectation that you're going to have offset from rising rates and from benign credit, against this backdrop of rising expenses, I think both of those assumptions are going to prove to be incorrect. And then, you combine all that with the fact that the financial sector is going to go from an 18% year-over-year comp in Q4 to a 133% comp in Q1, followed by 180% comp in Q2. And you sort of have the recipe for, a heads, fins lose and tails, fins don't win scenario. So, obviously, financials are a diverse sector. You've got 17 different subsectors. Not all of those, are subject to the same dynamics to the same extent. But two of the most exposed are regional banks and credit cards. And to that end, we've moved Citizens Financial, which is a regional bank, ticker CFG, Capital One, ticker COF, Discover, ticker DFS, all to the short list over the last week in anticipation of the ongoing Quad 4 and then deep Quad 4 environment here over the first half of the year. So, we'll continue to go through earnings. We'll see what else we get. But at this point, we've had a decent number of companies report. I think it's pretty clear what the sort of tone and tenor of the sort of perception is. And then on the macro front, today's going to be a busy day.
But before you go to that, just because I want to make sure that I just follow on to your line of thinking on that. Consider the alternative to what Steiner just said. Say you're a macro tourist. You're buying like bank stocks. Yesterday, you bought the financials because the Fed said they're going to raise rates. That is absolutely not the way to do this. What's amazing is that actually, he has some conflicts of interest. Even Jamie Dimon would say that. So let's call him a macro tourist while we're at it. When it comes to actually quads and rate cycle. So again, what actually happened was that the Fed, which controls the short end of the curve, raised rates. The long end of the curve didn't go up as much. So the curve the yield curve 10s, 2s is at its flattest point of the cycle. A flattening curve is bad for both credit. As Steiner said, what's been reported in credit is just early signs of lagging reports. What's going to really happen to credit in the next 3 to 6 months is real slowing, which will look a lot like the yield curve. So again, the first thing you do this morning is you short financials. You don't buy financials after the Fed raises rates. When the Fed raises rates, rates are going to go down. Okay. If this is just like Q4 of 2018, we made the same call. If you tighten into a slowdown, you can puff your chest out and peacock all you want there, PE pal, but you're going to flatten the yield curve. He could actually invert the yield curve. And everybody knows, even if you're not a macro tourist, that if an inverted yield curve is one of the highest and cleanest signals of not just an economy slowing, but a potential recession. Okay. So the Fed would be the catalyst for that. And then they're going to have to turn it around, cut out their rate hikes. Rates will fall faster, and your regional bank longs are going to get smoked. So just another way to think about this, obviously, than probably what you've heard on Consensus Monkey TV.
Yeah, and just to piggyback on that, I mean, the flattening of the curve and the falling of the long end of the curve in particular is really a reflection of the bond market pricing in an increasing probability of a growth slowdown. As we sort of converge, lower and lower toward that, ultimate zero line, that's the point at which, the bond market basically says, okay, party's over. We're obviously, or very likely, going into a full-blown recession. So keep a close eye on that, as we do. And then, On the macro front, we'll get jobless claims this morning. We'll get Q4 GDP, the initial read. We'll get durable goods. We'll also get pending home sales for December. So a lot of macro data coming in today, as well as earnings. So we'll have more to say on all that later on. That's it.
Yeah, in the short term, what happened was exactly what the signal said was going to happen. I took REITs and housing out for, in the very immediate term because I thought that the Fed was going to fuck this up, which they did. So rate sensitivity, even gold had a down day finally. Very short term, but again, we OODA loop that. That's called observing, orienting, deciding, and acting in the short term. For those of you that don't want to just give away money in the short term and have been, doing whatever, being a bag holder for life, for hodling. I mean, that's not how to risk manage markets. But from here, it gets much more interesting. Again, if we get housing stocks to be oversold and hold long-term tail support, same thing with REITs. They got to prove that. Consumer staples looks much better on the signal strength, obviously, because they didn't break trend, whereas the other two sectors did. I know that's a lot for people to keep inside of. Like if everyone has a thick skull like me, it's a hard thing to do. The game's not as easy as they try to tell you at CNBC or whatever the hell you're watching. But again, thanks for joining us. And Steiner's one of the best, so you probably just realized that. Reed, Rob, what up?
Hey, Keith. Morning. Pretty quiet on my end. A couple of earnings reports from SL Green and Duke, but lots of nothing burgers so far. It's pretty quiet. SL Green puts out its outlook in December every year for the forward year, so nothing on that front. Next Friday, I have my black book on Radius Global Infrastructure. It's ticker RADI. It might not be the best time to talk about it right now, maybe to revisit it on the other side of Quad 4, because I think it's actually one of the more interesting stocks in my space that I've come across. So there's probably a time and place for that. But either way, black book next Friday, and looking for that one. Forward to that one. Put out a note last night on that, kind of dealing with the return parameters that I see happening or playing out over the next 2 to 3 years. So anyway, that's all for me.
Good. And nice job with CJ Wilson yesterday. I thought that was, first of all, it was a fun discussion, but these are the kinds of people we want to associate with, not pretenders and posers on Twitter and being nice. We're talking about your money, okay? Hard-earned capital. People die, people lose money. That means something to a lot of you, and I know it does. We want to find the real players in the game who are transparent, accountable. CJ Wilson on crypto was fantastic, talking about how he runs his wealth. He signed a $77.5 million contract with the Angels. He's got plenty to risk manage. But the guy was just a great guy and the kind of people we want in the Hedgeye community. And great job by Rob in bringing him on board. All right, Van Sciver, you're mixing it up a little bit on Twitter last night, Jay.
Yeah, we'll get in it. It's earnings season. There's a lot to say, and Rollins.
What were you? What was agitating you, or who was agitating? Somebody was really agitating. Probably somebody without a name, right?
Well, I've had a lot of communication. I think I've been cut off by the Rollins management team, which is probably fair since I've told it. I think an accurate representation, but not their spin of it. So I emailed the CFO. I pre-submitted my question. I was asked to be in the Q&A, and as of now, she still hasn't responded. So I tweeted out the question and then pointed out that she should really let bears talk or whatever. That's a terrible decision on their part, because they have this problem that they've admitted repeatedly that they have given inaccurate organic growth numbers. And by organic growth, they left acquisitions in organic growth. That's not an accident. That's pretty obviously misleading. Nobody defines, the definition of organic growth is growth excluding acquisitions and divestitures, right? That is what it is. That is the only reason anybody bothers to do it, unless they take currency out or some other things, right? These numbers, they don't mean much. Even the revised ones they gave for 2021, you have no 2020 numbers, so you have nothing to compare it to. So, it could be an up 8% organic growth number versus a down 16 or whatever it is. It's just finally silly, and they need to get out in front of that. For our purposes, the next catalyst is, that was okay as a catalyst. It wasn't an amazing call. They didn't really say anything on the call. They didn't get
it was a great short call. That thing got pounded and continues to get pounded. That's why she won't reply. or she won't reply to you. The CFO won't, because you're telling the truth. I mean, when you and I started in this business, remember Howard Shillett?
Yeah. Oh, it's a great book, great author.
This is like, pre-internet. We're dating, Jay Van Sciver and I here, and a lot of us on the call with the gray hairs, as you can see. But, back then, accounting irregularities or outright frauds, we're not saying that Rollins is a fraud. We would never say such a thing. But misleading, accounting irregularities, it was enough for him to quite literally just put it on a report. The hedge fund community would just sell the stock and people would pay attention. Now we have the internet. We have a lot of transparency out there. We have this call going on. Howard Shillett was just phase one of holding people to account. This is the real deal, right? Whoever that CFO is, wherever she goes now, she's going to know until she answers the bell on answering these questions. She's not being transparent, accountable, or trustworthy, which is the Hedgeye mantra. So again, it's not always friendly or may not come across that way. But if you're a bad girl or a bad boy, we're gonna say these things, right? And we just don't say them out of nowhere.
No, I mean, and when you come into a mess like this as a CFO, she has an opportunity to have cleaned it up. But for our purposes, the next catalyst is the 10K, which is generally the very end of February. We have these dubious key performance indicators, such trivial ones like organic growth. There's also an SEC investigation into just accounting. And I think when you have a company that leaves acquisitions in organic growth, which is brutal. I mean, it's not like, churn is a little understated or whatever. This is first order. Everyone knows what this word means, and they've done it this way for a long time. And you just had this big board turnover. What else are they doing that is kind of squirrely like that? And you got the SEC going through the accounts. The SEC isn't saying anything about the organic growth numbers, which they admit, right? This is something that they're looking at accruals, right? Which is the kind of accounting we use, accrual accounting. So it's a bigger deal. I should also quickly just hit on Rockwell, because that's out. We moved that name down our long list coming into 2022, even if it's the one that probably among the best or the best over a tail duration, a few years. Rockwell isn't a great quad 4 performer, and it has some of the growthy holders and factors. They're kind of meme stock factors that have trended less well coming into this year. It's a robotics company or whatever, so it gets tied up in that in a way that a Packard just never will. The EPS came in a little bit ahead, $2.14 versus $1.93. But what's interesting is that first quarter orders were up over 40% year over year, with organic sales up 17%. These guys are drowning in demand, and that's actually part of the problem. And it's been a theme so far for manufacturers training season. If you check out our Oshkosh note in our direct and recap note that went out this morning, the backlog, particularly for aerial work platforms, I've never seen a mature industrial backlog chart look quite like that. It would be mooning, I believe, in the parlance of the kids today. But for aerial work platforms, these are cherry pickers and telehandlers and things like that. In the access equipment division, it's kind of weird, but that's what Rockwell looks like on this automation side. Margins also slipped, similar to Oshkosh, and that's because you have this mismatch that we keep flagging between pricing which is in backlog, which is back a little bit typically, versus the cost that they're incurring. It's down 70 bips, not a big deal. This is a company that basically has a 20% operating margin, so it's not massive, but it is something that you get back in the second half of the year, which is probably when we move this back up the list. As you get out of the kind of more deeper quad 4 environment into 2H, and a lot of that order activity will start to translate into sales. The actual guide didn't move in a way that's meaningful. I doubt we see too much about it, but that's the gist on Rock.
Yep. Good. Nice job moving that down the list. I mean, and when it moves down the list, I move it out. I mean, it's anyone who has a managed account with one of our asset management partners knows when Rockwell came out. I mean, it's not like we don't act on these things, or at least they don't. I'm not running money for them, obviously. But 2 minutes or less on Tesla it's gone from
the signal nailed it. Quad 2, it was a long last year. It went to talk about mooning, went to the moon. It's the number one story stock, I guess you could argue, with the most cap and the most downside. If it remains bearish trend, so they report the numbers, it's going to have to be up 6% to recapture the flag or recapture my trend signal. I will short anything that's bearish trend right now. And in this one, like I said, now it's you got like 90 seconds, but 90 seconds, like should we short Tesla on all bounces going forward?
I think yes. I think it's an increasingly, what's funny is like as these models mature, they become, you see the evidence of it being a more mature manufacturer. Like bringing a new car model to market is a huge undertaking. It's capital intensive, time consuming, takes focus. So they're delaying the Cybertruck, and I mean, there is no semi or whatever. So all these other things that they're theoretically doing, and they're, the people on the earnings call are I can't use the words, it's special, right? It's not a great mix. They're talking about the Tesla robot, which is, if you think the semi truck doesn't exist, wait till you see that robot that's going to clean your house. Like, what are you people, like gullible? Like, what's wrong with the shareholder base? But they buy stocks and the stock goes up. They buy calls, the stock goes up. But what you'll see as they face the struggles of a mature manufacturer is a convergence of the valuation and expectations and narrative between a VW or a Ford and Tesla. Like, oh my God, they have the exact same challenges that a capital intensive, relatively low margin, long lead time, high risk development project manufacturer has. That's because that's what they are. And all the other stuff, the sort of the promotional, misleading, full self-driving. I mean, there's so much crap. Like, you'd have to be the most gullible. It's unbelievable to me that it trades where it does. So I was, wrong last year. It's in the direct note this morning in the summary of it. They're going to build factories to build the same cars in a more competitive environment without a new product. I think that's pretty bearish. But it's one that's tricky and exhausting.
Yep. Well, there's a ticker for gullible now. I didn't appreciate that up until recently, but Gerber Kawasaki, gullible, yeah. GK. Were they triggered last night? And I realized it's some money man. He claims he's a money manager. So I look him up and he's chirping me about chirping Gerbs. And I'm like, literally, I looked on LinkedIn. The dude, his entire career was a marketing and then a creative director. And then when Story Stocks came in the last year, he started an RIA. I'm like serious? These are the gullible. These are the people we're talking about. We're not being bullies. We're saying this is your capital. It's hard-earned capital. Be aware of all the charlatans on Wall Street that always appear during Quad 2 bubbles. Okay. Super important concept.
They take companies that are in the business of selling stock, and then they turn and sell that stock to the gullible people, that they're like an intercessor.
Oh, and then the guy from Advisor Shares who manufactures the ETF, who gets a fee on it, doesn't have to generate alpha, is chirping me too. I mean, it's like, let's go. I'm a hockey player. This is not gonna end well for you guys. All right. Thank you. That was fun. Ami, you got some Qualtrics action on the tape?
Yeah, we got Qualtrics, ticker XM, 13 billion market cap company reported last night. We've had it on the best ideas long, and that hasn't been a great run for us over the last year. They reported last night, and one of the things that's been weighing on the stock all year is this comp that they were supposed to report last night, this 4Q21 comp and billings, which was supposed to face a pretty difficult cliff. And because of the strength of their 4Q20 benefit that they had, kind of like rolled up all their orders from COVID, kind of got delayed all through the year into the fourth quarter. So they had kind of this big fourth quarter albatross. And when they reported last night, they delivered sustaining growth metrics, which leapt over a tough bar. This has been, so I hope this is going to be an albatross that has, now passes. I would say that there were some puzzle pieces of where you could see where they did have kind of like there was like a period of COVID boost. There's no question about that. But now that we're getting past that and we're comping comps, I think that what people should be able to see is they're sustaining like high teens growth in customers, and they're going to sustain something in the range of 20% NRR, which is like a way of saying like ARPU growth for, revenue per customer growth for, kind of like for existing customers. So when you put that math together, you're going to sustain subscription revenue growth, which is the key driver of the business, of the profits, of whatever, in the mid 30% this year, and probably better than mid 30% for this year and much into next year. So I think this one to me is worth at least $40. I think there are always interesting puzzle pieces with Qualtrics to look at. It happens to be one of these companies that continues to chase new technology creation, meaning internally they build and build and build at a very aggressive pace, to the point where customers recognize it, employees complain about it, kind of thing. And with that feature and function creation, the more technology supply they put in the market, the more demand creation they have. So I like that one, continue to like that one. Hasn't been a good call so far, but I could see that one being worth at least 40 on a, call it a 6 to 18 month basis, and more bullish than that beyond that. I would say this is like I think this is a good one. But I've thought that all along and we've been wrong. I'll just mention one more thing. We put out an invite yesterday.
Well, you may not be, wrong fundamentally, which is kind of the point, or is the, not kind of, it is the point about Quad 4. Quad 4 crushes growth stories. That's it. Until they go down enough and then they report reality. This is kind of the point with Playboy, is that, Qualtrics can be up at least a lot on the open. So it's not like they have to go down throughout the entire Quad 4. It's that they can go down before they report that they're actually a growth company. And anyone who doesn't know how to risk manage that yet absolutely has to be able to. It's like saying you're a big time boater and you don't know how to swim or need life jackets. The whole concept of hodling without any risk management is a joke. But that to me, that's what happened with this stock. Longer term, it's always been one of, long term, like 3 to 5 years, which is, what I think you're talking about, or at least 6 to 18 months.
Yeah, I think that's right. Absolutely. Definitely the most painful part of the performance has been during the Quad 4 period, for sure. Anyway, moving from Qualtrics, I want to mention one more thing, which is we put out an invite for our next idea hunt. We haven't done one of these in a little while that we've shared. We do it every quarter, but we haven't publicized that. So we're going to have an idea hunt next Tuesday at 10 a.m. We're going to go through CrowdStrike and Coupa and Alteryx and Snowflake and DocuSign, DigitalOcean, and Amplitude. So that's Tuesday at 10 a.m. We'll move from there into single stock black books on as many of those as we can get done.
Nice. Single stock black books, those are deep dives. So that might be, 50 to 150 slides if Steiner's doing. It's 150 slides. If it's somebody else, maybe 60 or 70. I don't know. But that's what a black book is. Friedman, yeah?
Yep. So Bill Ackman bought $1 billion worth of Netflix. Thought that was interesting.
Yep. The question is, how much Netflix did he own on the way down? Because once he gets loud, old Bill, he just can't seem to grasp the Quad 4 concept. He always gets body bagged in Quad 4.
Yep. So we'll see. Looking at kind of the press release that came out, it doesn't look like there's anything too insightful or new or really edgy to his thesis. It's more just a reiteration of the same bull thesis that management's been talking about, and that's pretty pervasive. And then, he's leaning on the work that they did around UMG last year. But as I tweeted out last night, his entire UMG presentation, or the bull case, is basically kind of the bear case for streaming video. So a little bit intellectually inconsistent to some extent, but we'll see. And he was also basing his entire valuation model for UMG off of Netflix's multiple, which has gone from like 35 times EBITDA down to 24 times EBITDA. So I guess in that sense, he's incentivized to support Netflix stock if that's his valuation framework for UMG. But other than that, we have our monthly wrap call tomorrow at 12:30. We're going to go through kind of Netflix, revisit the TAM assumptions. We're going to hit on all the internet advertising names, usage trends, monetization trends before we have earnings next week. And then we're going to go through kind of the online dating space and what the data looks like so far to date.
Cool. All right. Thank you. Felix, yeah?
Hey, there's just another rumor in the game live streaming industry, but I'm writing my note on it, so I'll talk to you about this tomorrow.
That's it?
That's it. Sorry.
No, that's good. We only have 5 minutes left. Glenchur.
Yeah, good morning. So we have a Supreme Court nomination coming, and to me, the question becomes, how much of a fight does Joe Biden want to have on this one? The leading candidate people seem to be focused on is Judge Ketanji Brown Jackson. She has been confirmed before with 3 Republican votes to the appellate court. That's not a lock that she'd get those 3 votes in a Supreme Court fight. And I think there's a couple other nominees, Leandra Kruger from California, Michelle Childs in South Carolina, who's backed by Jim Clyburn, of course, someone who the Biden administration owes a lot to since he was critical for Biden becoming president after the South Carolina primary. He backs her. So I think the issue becomes, how much of a fight does he want to have over this one? If it's contentious, it takes time, and time matters because there's other things in the Senate that they need to get done before the midterms. And a contentious battle, this is issue number 1 now for the Senate, the nomination for the Supreme Court, getting the justice confirmed. So I think that it's an issue about how much of a fight they want to have, how much it could displace other priorities, Build Back Better, semiconductor funding legislation, et cetera, that's on the Senate agenda. And it could have some impacts for the midterm. JT and I have been talking a little bit about this and sort of what the bigger impacts are. So if JT's on,
yeah.
I'd like to get his input.
No, I'm here. And Paul, but just before I say a few things, so, talk about there's no shift in ideology on the court. You're just replacing Breyer, right? So this doesn't change that dynamic.
It's still 6-3. Conservatives have the majority on this one, even with the confirmation.
Yeah, quickly. Yeah. So, people that are on the call right now, because today's free, they're probably wondering why we just pivoted to Washington. These guys run our policy research. We have a Washington office. We have a Boston office, which isn't policy research, but Glenchur, Neil Howe, and for those of you that love Neil Howe, like we all do, chief demographer of America and the world and beyond, really. And JT, all these guys work together. So that's how we take the edges of policy to inform not only the quads, but the pods and company risks. Obviously, Paul's doing all the legal edges, but that's who these guys are. Paul, was that it for you?
Yeah, that's it. I'm on JT's input though on I think some broader political impacts. We got to
so again, so first off, Paul's 100% right that this is going to take time up on the Senate calendar, and as I've said many times before, that's a premium right now, and they do have other priorities they want to get to. They do have other things to pass, but this does change the narrative for Biden, at least for the moment, and gives him a little bit more fodder, shall we say, for the base. Paul and I have been walking through what we think no one else in Washington is talking about, which is the entire narrative, midterm narrative is focused on the Republicans taking the House back and maybe even the Senate. And we buy into that. Yes, all the trends are favoring the Republicans, but kicking off with the Supreme Court nomination coupled with Roe v. Wade coming up this summer. There's an affirmative action case that Paul can talk about and we'll talk about later. We have guns, religious institutions. There are 4 or 5 things on the Supreme Court docket that could really energize the Democratic base here going into November and maybe pare back some of the Republican gains or make it a fairer match. I'm not saying that the Democrats are going to keep the House, but I'm saying that everyone thinks that it's going to be a bloodbath for favoring the Republicans right now. What we're saying is there are a series of events at the Supreme Court kicked off now by a new Supreme Court justice that could really help energize a badly downtrodden Democratic base.
Yeah, that's again, why we built this place. I mean, you can turn on any channel of media other than this, and thanks for joining us. But, if these guys aren't apolitical, they're not working here, right? I'm not a Republican, I'm not a Democrat. Yes, some of the players on the team are, but it has nothing to do, our political biases should have nothing to do with any risk management decision that we're trying to help you make with your hard-earned capital. Never, right? There's no emotion. Like when we talk positively about Republicans or negatively, it shouldn't trigger you. If it does, that's fine, but it's not going to change how I'm using the edges of policy to inform like I said, the quads, and at the company level, different pods. So, so thank you to everyone who joined us today. I'll see you guys on the macro show too.